Good evening. I'm Shraddha Bavla and you're watching What Did You Miss? Let's start with the headlines. It's a strong start to the trading week with the Nifty and the Sensex ending the day at record highs. Lupin meets estimates in the second quarter, but the management says that the pricing pressure remains in the US. And strong loan growth aids HDFC's bottom line in the second quarter. While Tata Steel is also expected to report a strong set of numbers led by a recovery in its India business. Well, IDFC and Shriram Capital are set to call off the merger plans after the two sides failed to arrive at an acceptable valuation. That's a Bloomberg News report. Well, cheer continued in the markets with both benchmark indices registering healthy gains. Broader markets too saw gains of over 1%. Neeraj Shah standing by with all the equity action that we witnessed on the street today. Neeraj, what have been the key movers and shakers in trade today?
Well, it's an interesting day of trade simply because we were buoyed by the Nifty Bank, which only came off towards the second half of the last 1 hour of trade. But we still did reasonably okay. So about 40 points for the Nifty, about 100 odd points for the Sensex, and the volatility rose as well. India VIX did go up in the session today. So that was the one interesting part that happened. Now let's look at individual names. 5.5% for India VIX, yes, but look at individual names. So crude price rise resulting in gains for companies like ONGC and some of the oil exploration companies as well. So a bunch of those mid-cap names, the likes of Ceylan and others, had a fabulous day of trade. There was a results reaction and a sharp one that was seen for Lupin. In fact, short covering led the stock to as high as 8%. But just the fact that the numbers were not as bad as the rumors on the street were suggesting led to the stock moving up 2.5%. The commentary from the company on what the US business could do slightly disappointing and therefore coming off. UPL, not a bad quarter, just that the top line growth could have been a bit better. Some of that was not the case, so ending fairly flat. What about some of the other result reactions? So fairly strong results by Ramkrishna Forgings over the weekend. The stock starting off 16% higher, ending the day about 6% higher, still pretty strong. And Century Ply, otherwise a fairly strong stock. I think this quarter, because of GST and other factors, they couldn't do well. The management commentary also sounded a bit skittish. The stock ending flattish in trade. A couple of stocks which are buzzing around. The Nifty Pharma Index itself buzzed, yes, but Sun Pharma Advanced Research, for no apparent reason, or at least reasons that we don't know of, went up about 15% in the session today, 438. This would be near 3-4 year highs or maybe even longer than that. So really strong move that came in for Sun Pharma Advanced Research. Last but not the least, I know I'm pointing out all gainers, but look at the moves that happen in some of these, and both of these stocks hitting fresh life highs. Gillette about 6,000, Escorts about 775. Good moves for these as well. Back to you.
Well, thank you for that, Neeraj. More gainers than losers, that's good news. But shifting focus to the telecom sector, which is not expected to recover in the second quarter. The average revenue per user is expected to remain under pressure, denting margins. Somit Sarkar is here to take us through the expectations. Somit, how do the estimates look?
So the second quarter for telecom companies will be weak, not only because of the seasonality impact, but also because of higher tax rate under GST and the competitive pricing coming in from Jio. Now, under GST, the tax rate was fixed at around 18% versus the 15% under service tax. And this and the telecom service providers were not able to pass on this hike in tax rate due to the competitive pricing that Jio brought in this quarter. Now, in the second quarter, the two telecom service providers, that is Airtel and Idea, will see a fifth consecutive decline in their average revenue per user. Now, Airtel's average revenue per user is expected to come in at 146, while that of Idea at 135. Now, if you see company-wise, Bharti Airtel, that's the biggest telecom company in India, will see its consolidated net profit decline by 8% in the second quarter, but its African business will see gradual recovery with growth in the top line and margin expansion coming in due to cost control measures taken in by the company. On the other hand, Idea Cellular will see its financials worsen in the second quarter. Now, EBITDA is expected to decline by more than 20% to 1,484 crore rupees, while it is expected to post a loss again. But this time the loss will be more than 1,000 crore, and this could be also the fourth consecutive quarter where the company will be posting a net loss. Now, Bharti Infratel, that is a tower infrastructure company, is expected to come out with its result today, and it is expected to see a good growth. Now, revenue is expected to rise 10%, EBITDA is expected to rise 12% as it will benefit from improvement in energy spreads, but the bottom line on the other hand will decline by 5%. Now, this decline will be on the back of lower other income and higher tax expense. Now for Bharti Infratel, tenancy ads in the second quarter could moderate, but management outlook on the same will be a key things to watch. Now along with that, management commentary on share buyback plan, if any, because they have a good cash balance on their book, and management commentary on mergers and acquisition could be a good key thing to watch out for.
All right, thank you for that, Somit. And of course, the telecom sector will remain in focus. We also have the Reliance Communications a press conference announcement later today, which we will address. But moving to Tata Steel, which is set to report its second quarter earnings in some time from now. It's likely to be an operationally strong quarter for the Indian steel major. Nikki Mirchandani is here with all that the street is estimating. Nikki, net profit is what is expected this time around.
Good set of numbers. We are good set of numbers coming in. We expect good set of numbers coming in from Tata Steel. Top line, we expected a growth of around 23% at nearly 32,296 crore in this quarter, as compared to 26,371 crore in the corresponding quarter. We are expecting the EBITDA to rise as much as 76% at 5,235 crore versus the base figure of 2,970. Margins are expected to are seen expanding at around 16% as compared to 11% in the base year. The company on consolidated basis is expected to report a profit of nearly 1,663 crore as against a loss of around 49 to 50 odd crore in the corresponding quarter, mainly led by improvement in the domestic performance. What do we expect? Volume growth have been already given now on consolidated basis. The volume is up as much as 15% YOY, and on for Indian operation, the volumes are up as much as 19% due to Kalinganagar ramp up. A strong volume growth along with high domestic sale is expected to reflect well in the top line growth of the company. Besides that, on the operational front, we are expecting some kind of sequential decline taking place in coking coal prices, which are expected to moderate. Thus, improving realization, lower input cost is expected to reflect well in terms of the operational efficiency of the company. The company is expected to report a growth of nearly 60% in terms of its EBITDA per ton. The Indian on standalone basis, we are expecting a number of around 11,828. That's on the lower side. On the upper side, we are looking at an estimate of roughly 13,500. Two things we'll keep an eye out on. First will be the coking coal prices, which are expected to moderate, and also EBITDA per ton growth of European operations, especially on sequential basis, because the seasonal effect is expected to be on play on for this one.
All right, thank you for that, Nikki. Breaking news coming in over here. The IDFC board has called off its merger plans with the Shriram group. Both the groups have decided to call off the merger. The groups have not been able to reach common ground, and they say that they're unable to agree on a mutually acceptable swap ratio. We have Ira Dugal joining us on this. Ira.
All right, Shraddha, I think the news is finally formal. We've had a bunch of publications, including Bloomberg News since the morning, report that IDFC and Shriram groups are not likely to be able to reach a consensus on the merger. The key issue has continued to be the complexities of the deal, and in particular the valuations. Remember, this was a deal which had various legs to it. You had one entity, which is Shriram City Union Finance, which had to be merged into IDFC Bank. Shriram Transport Finance was going to be left separate and would be held by IDFC Limited. Plus there was the insurance businesses as well. Over the last few days or weeks, news has emerged that particularly the largest shareholders of IDFC Limited, which is Khazana and the Government of India, were not happy with the dilution that was taking place as a result of the swap ratios being discussed, and that was one reason why they were not in favor of it. So finally, what they have said in today's statement is that the board of directors, which had approved entering into a confidentiality, exclusivity and standstill agreement on the 8th of July, has now said that the exclusive agreement is not going to stand for now. Given the due diligence process, the parties had agreed to extending the date up to the 8th of November. This has now been put on hold because a mutually acceptable swap ratio has not been agreed upon. So essentially, for all intents and purposes, it looks like the deal is off unless at a later stage they come up with a different formula within which to go ahead with this particular deal. We'll try and get some analysts to react to this as well. But just to give you a sense of what the other issues with this deal were, of course, the primary issue was that of the swap ratios and coming up with swap ratios which were acceptable to all shareholders, IDFC Limited shareholders, IDFC Bank Limited shareholders, and the Shriram Group shareholders. And also remember, there was Ajay Piramal, who holds equity in Shriram Capital, and his shareholding also had to be adjusted in a way that it does not breach the Reserve Bank of India's rules of one shareholder having more than 5% in a bank. That was an additional complicating factor. On top of all of that, there were regulatory issues as well, because remember, the RBI ideally would not want such a large consumer finance business as Shriram Transport Finance to be kept out of the bank. But at the press conference, when Rajiv Lal was repeatedly asked this question as to why the regulator would allow you to do that, he said that, we have had some discussions. We feel there is a possibility that the regulator will allow it. I don't know if it even went to the regulatory stage, because at this stage, it looks like shareholders themselves have not agreed to go ahead with this. We'll try and get some reaction. Shraddha, you may want to look through how the stocks have been performing. I guess this news came out after the markets closed, but I think there was some reaction in the markets this morning and perhaps even on Friday and Thursday when this news had started to trickle in.
Absolutely. In fact, I'm assuming, Ira, that we will see some positive reaction on these stocks yesterday, because when this merger was, exclusive agreement for a merger was announced, you had analysts saying that it wasn't really a good deal, especially for the Shriram group of companies. This news, of course, like you said, has been out since morning in various publications. But if you see, IDFC Limited closed about 2.2% lower in trade today. If you look at what IDFC Bank actually did, that stock was actually down another 2%. So both these IDFC group companies were seeing some profit taking today. You had Shriram Transport Finance, of course, trading 1% higher, and Shriram City Union, yet another company which was going to be a part of this merger, also gained close to 2%. So both these stocks, the Shriram group of stocks, clearly you can see were actually seeing a good positive up move, while the IDFC stocks were seen taking a beat. But when we did speak to analysts last, they did say that it would be a bigger positive for Shriram. Ira, anything more that you've picked up?
Not picked up, Shraddha, but just in terms of completing the analysis on this, I think the post-deal breakdown analysis needs to focus a little bit more on IDFC Bank than any other entity. Remember that Shriram, Shriram City Union, Shriram Transport are all businesses which are at a sort of a mature state, if I may call it that. They've had a steady sort of growth. There have been some issues in terms of asset quality because of demonetization, which the management, when we spoke to them post the merger announcement or the initial announcement, had said have all settled down. So those businesses are steady state. But remember, what had driven this merger in many ways was IDFC Bank's desperation, if I can use that word, for scale. And it was actually just that. IDFC Bank has struggled to find retail scale, particularly on the liability side, also on the asset side. In fact, their retail assets largely is what they managed to garner through that one microfinance institution acquisition that they had done. But other than that, they have not seen much success in terms of building out their retail franchise. And that is what had driven this merger, or the attempt for this merger, at least from Rajiv Lal's side. He took the podium at that press conference and said that this is the way he wants the bank to build out. He wants the retail assets to come, and then he's going to use that network that Shriram City Union and Shriram Transport Finance have to also build out a retail liability franchise. Now with this deal breaking down, the question has to be asked, the tough questions actually have to be asked largely to IDFC Bank, because where does IDFC Bank go from here on? What is their game plan to build out their retail franchise, assets or liabilities? And if they can't do that, what do they do? Do they remain a purely corporate-focused lender? You could argue that at this point in the cycle, where perhaps 1.5 to 2 years down the line, you will see some investment demand come back. Maybe IDFC Bank can leverage its core strengths and get back into that corporate lending business as well. But on the retail side, it's going to be very tough for them to build out. Urban centers, as we keep saying, are highly sort of concentrated. You've got the large banks, the big guys, HDFC banks, ICICI banks, Axis Bank, SBI, all of them populating the urban tier 1, tier 2 centers. And if you go beyond that, tier 3, tier 4 and all of that, then, building out businesses in these geographies is not that easy. It's, a lot about the brand connect, and IDFC doesn't really have a retail brand connect. So I think the tough questions to be asked are to IDFC Bank. In terms of IDFC Limited, I think the shareholders of IDFC Limited will perhaps be fairly at some level happy because they didn't want to see the kind of dilution that they were facing. And so in that sense, it may be good news. All right, we've got the analyst at Prabhudas Leeladhar joining us on the phone line. Good afternoon, sir. Thanks so much for taking our call. Appreciate it. Quick thought on the fact that this deal has broken down. At least stocks have broken down.
So basically, I think the swap ratio has not been come upon by the respective boards, and that's the only reason why the merger was called off. Because I think earlier there were two things going on from each shareholder side, that IDFC cannot go below their 40% mark of shareholding. So they couldn't give a favorable ratio to the Shriram Transport side of the business. And Shriram Transport shareholders were also unhappy with the swap side because they were not getting their fair value in terms of the swap. That's why the main reason is that from that perspective it has been called off.
How do you see this playing out for the individual, listed entities? And there are 4 of them that we need to talk about. So let me start by asking you about IDFC Limited and IDFC Bank. What do you think this means for share prices of those 2 companies?
See, basically, I think IDFC Bank also should slightly, be on the negative side. And I think there will be some difficulties and challenges because they have been undergoing some challenges on the business growth front. The way the business should have been built in terms of growth rates and the flip they would have got from this merger would have been substantial. So they would have got a very good retail side of a business, asset side of the business, as well as some liability side, but they would have benefited much more. But I think more on the negative side for them. Yeah.
For Shriram, Pritesh, more or less, for the 2 Shriram entities, City Union and Transport, it's back to sort of steady state business, right? They had no major problems going into this. This could have potentially helped them maybe, by getting them the banking license access. But now that it's been called off, probably not much of a, positive or negative for the shareholders there?
Yeah, so basically business as usual for them. But what happens is because there was an overhang, because of the structure and the swap ratio, Shriram Transport somehow underperformed comparatively. Their valuations are much lower if you compare it with the sector per se. So I think there we have been, recommending a little bit if, the swap ratio is in favorable of Shriram Transport, that stock should rally. And if it falls through as well, then still it should rally because we were factoring in that the swap ratio cannot be beyond a point because of the shareholding of IDFC Limited. So basically it favors the Shriram shareholders as such in an indirect way.
Okay, got that, Pritesh. Thanks so much. Appreciate you taking the time to give us a quick take on what this means for the individual stocks. Let me get a bigger picture as well. Ajay Bagga of OPC Asset Solutions joining us on the phone line. Good afternoon, Mr. Bagga. Thanks for taking our call. Your thoughts on these stocks breaking down? I have to say that when the merger was announced, a lot of people were skeptical about whether they'll be able to close it. There were just so many complexities on the business side, on the shareholding side, on the regulatory side. So in some ways, not a huge surprise that they haven't managed to close it.
Yeah, absolutely. Unfortunately, because of compliance reasons, I can't give a particular buy or sell call on on the 4 entities. But overall, seeing it, one was that the valuation itself, and second was the cultural difference. The way Shriram has been brought up and it evolved from the roots of Shriram are again very ethnocentric. It's a very different culture from the IDFC culture. So even that would have been playing in the mind of employees, in the mind of other stakeholders. But overall the valuation itself was difficult to achieve, and given the constraints by which both the parties were working, it was a difficult move. It would have created a unique entity, given a fillip to both parties and both shareholders, definitely access to very different markets, different segments, and the deep knowledge that Shriram brings of its segments and IDFC on the infrastructure side. So there were enough benefits that the shareholders were looking forward to, but it has to meet the valuation criteria of both sides, which could not be met.
Mr. Bagga, completely recognizing that you have limitations on how far you can go in your commentary. But even if this deal had closed, you were talking about the cultural differences. It wouldn't have been an easy merger to sort of absorb, right? From managements to who leads the business, particularly who leads the Shriram businesses from here. The Shriram shareholders are very strong. They have a trust. So even if this had fructified, the actual benefits of it playing out for IDFC and the IDFC Bank Group would have probably taken a long time to show up on paper.
Definitely. And as you mentioned, Shriram being held in a trust, then the Piramals being involved as the major shareholders in Shriram. So the erstwhile management of Mr. Tyagarajan and all the senior people who have grown with him, who have grown this business. Then Mr. Piramal's team, and then the IDFC team, which is again made up of professional managers who started this company, many years back, and took IDFC, then got the banking license, have launched this. So there would have been quite a bit of a difference in culture, especially from Shriram's side, which is basically got its roots in the chit fund business and then going into truck financing, transport finance pioneers. But again, being very, centered in a few locations and conveyed to a few segments where, they are known for relationship pricing, of standing by the truck owners through thick and thin. It's a very different model from a, usual bank which would invoke DRT and seize trucks and stuff. It is a very different culture.
100%, Mr. Bagga. Mr. Bagga, just last question. For IDFC Bank from here on, it's going to be a tough road, right? I mean, banking has never been an easy business, particularly now when the market is concentrated. You had Bandhan and IDFC Bank get the license together. Bandhan had their own network to fall back upon and grow. IDFC Bank, it was from scratch on the retail side. Do you think they'll have much success in sort of organically building out that franchise?
Well, there will be other opportunities, I'm sure. There are other networks available. That is one. So in terms of, buying out, I think there will be other buy and bolt-on options available. Second, IDFC has done a fantastic job on the digitalization. They have really not put down the money on the brick and mortar. They've tried to go the digital route, and I think the jury is still out. And third, because of the changing rules, where first they had to do a demerger, and now the rules would allow a back merger again. So let's see what they come out with. It's a fantastic management. I don't think we have given them enough time. So, I would not pass judgment there. And given the way technology is disrupting the whole banking scenario, you have ATMs being shut down, branches being shut down. I think they have been very wise in not putting down that kind of infrastructure instead of focusing on the technology side. Yes, this network would have been a huge fillip. Now they'll have to look at some other network to buy and bolt on. I think that would be the route they go, but all pure speculation.
Absolutely, Mr. Bagga. That's what we're all sort of doing right now till we hear from the IDFC management. Thank you, Mr. Bagga. Appreciate you taking the time to speak to us. Just wrapping up and throwing back to Shraddha with a repeat of the news that the much sort of famed merger, multi-part merger between IDFC Group and the Shriram Group has fallen through. Exclusive talks have been closed because a swap ratio that was acceptable to all shareholders could not be arrived at. Shraddha, back to you.
Thank you so much for joining us, Ira. So that's putting all the speculation to rest. No deal is what the outcome of this has been. All right, now we shift focus back to earnings. The pharma major Lupin saw a profit beat estimates with a healthy set of numbers in the September quarter. Darshan Mehta standing by to take us through all the details. Darshan.
Shraddha, it was pretty much in line with what the street was anticipating. Basically, the counter moved up 8% on the back of short covering, and once the management came on the conference call and there was a press release in terms of what individual performance they had done, the counter managed to cool off. Now, as far as the top line is concerned, it's a 100 crore miss. The profit coming in at almost 855 crores, 455 crores versus our estimate of 433 crores. Margins were pretty much in line. Now, the disappointment was there is the fact that the US business did not do well. So there was a 32% degrowth on a year-on-year basis and a 15% degrowth on a Y-on-Y basis, despite the management indicating that it will be marginal. So that's the first big disappointment that came in. Other income was much higher, 75 crores versus last time around 21 crores. There is a high estimate of forex being booked there. So that is something that we will come to know only once the conference call comes in. And finally, the tax rate was much lower. So the commentary was very, very weak in the press conference. The management indicating that the pricing pressure will continue, and they're not despite this number, they're not revising their guidance of a single-digit revenue decline for for FY18. So on the back of that, the commentary was weak. The internals showed that the headline number that just flashed were not as strong as what it was anticipated, and the counter correcting almost 5 to 6% from the day's high.
Not surprising. Thank you for that, Darshan, because the pricing pressure might continue is what the Chief Executive Officer at Lupin, Vinita Gupta, said. She also states that no product can offset price erosion in big-ticket products. Listen in.
It's been a challenging year in the US, and as you mentioned, the pricing pressures continue. We've had multiple rounds of consolidation through the year. We've just seen the impact of the Walmart McKesson consolidation, and sometime over the next 12 months, we're also going to see the impact of ESI and VBAT consolidation. So we expect to see some more pricing pressure through the year in the US. In terms of new product launches, we have a number of product approvals, but in terms of products that can really offset some of the price erosion on big ticket products like the Glumetza and Fortimet, we don't have those kind of opportunities in the year. So we're trying to get as much as possible out of our current portfolio.
Well, the stock of Lupin did close about 2.5% higher, but yet another company that reported earnings was HDFC Limited, where we saw a broadly stable set of numbers, the company meeting estimates while steady trends continue. So the net profit grew 15%, 2,100 crores. Net interest margins came in at about 3.9%. Provisions were steady on a quarter-on-quarter basis, by the loan book grew about 17.7%, broadly in line with the trends that we have seen in the past few quarters. The overall gross NPA number was also stable at 1.14% versus the number of 1.12% in the June ended quarter. Nevertheless, the slight disappointment came in with respect to the gross NPA number on the non-individual segment side, which rose to 2.18% versus 2.09%. Spreads were absolutely stable at 2.29% unchanged. So more or less, good set of numbers coming in from HDFC, broadly in line with what the street was working with, and the stock did close with marginal gains. But with that, we're already halfway through the earnings season, and we at Bloomberg Quint take a look at how the second quarter has panned out so far. Darshan Mehta standing by with the scorecard. Darshan, more green than red this season?
Yeah, it seems to be, but it's more yellow at this point of time, because if you look at the numbers that are in line with estimates, so 26 have reported numbers. 5 are strong, 16 are in line, and 5 are weak. So pretty much even Stevens among the strong and weak, but it's more an in-line set of performance. Now let's take a look at what's happened. So this was the fourth quarter, what had happened, in which in-line numbers were 10, and look at where it's moved up from 10 to 16. And look at the numbers that were strong, it's moved from 11 to 5. The week have pretty much stayed the same level. So a lot of strong earnings that came out in the last 2 quarters, they have managed to report in-line set of numbers. Now, this is the heat map. This is the yellow I'm talking about. Green, you have 5 companies which reported strong numbers and 5 which reported weak numbers. But even here, Axis Bank and Yes Bank, it was weak on account of asset quality issues. But overall, it's rather in line. Now, let's break it up. Autos, Bajaj Auto and Maruti came out with strong numbers. The margin expansion was clearly seen there. So, auto company, yes, a strong set of numbers. Now, let's take a look at the cement companies. 4th quarter in a row, Ultratech has managed to come out with strong set of numbers. Ambuja was a little disappointing compared to an Ultratech on ACC. ACC was in the Nifty last time around. It's out of the Nifty. Consumer companies, ITC, Asian Paints, HUL, all of them in-line set of numbers. Volume growth was in line. So, there was no surprise that came in. The disappointment came in Reliance. Muted quarter for Reliance this time around. The stock price moved because of this reason. Jio turned a bit positive and that took the entire telecom up with it. Indian Oil and ONGC were disappointing. For private banks, it was an inline set of numbers for all of them. There was no surprises that came in. But the asset quality weakness was clearly seen in 2 banks, and that was because of the RBI divergence that came in. So you had Yes Bank and Axis Bank which reported weak set of asset quality. Yes Bank, financially, the numbers were decent for Yes Bank. Non-banking financial companies, Bajaj Finance inline, HDFC inline. But Indiabulls Housing Finance came out with a strong set of numbers. Now, let's take a look at the other set, and that pretty much will be the IT pack. All of 4 of them met estimates. These are the large 4, and guidance was weak. Guidance was a concern across the IT segment. Now, Z came out with numbers which were strong. Ad revenues were extremely good. So, for the media pack, yes, Z came out with strong set of numbers. What came out with numbers today? Lupin from the pharma pack came out with an inline set of numbers. Now, the internals are pointing to slight bit of weakness that is there as far as the US markets are concerned. So, the start for the pharma sector is not good. So, Lupin meets estimates, and HDFC came out with numbers and UPL came out with numbers today. HDFC we already spoke about, but UPL was the big disappointment that came in. So, the only company in the agri space that is part of the Nifty, disappointment as far as numbers were concerned.
Thank you so much for that, Darshan. Not too many surprises this quarter. But moving on, HDFC Life is all set to get listed. Now, the country's 4th largest life insurer is looking to raise 8,700 crores from the primary market, which will see the promoters making an offer for sale. Riddhima Saxena spoke to Deepak Parekh, the chairman of HDFC, on the upcoming IPO. Listen in.
I'm joined by Mr. Deepak Parekh, Chairman of HDFC. Hello, sir. Sir, the price to book of this particular IPO, although you've said that you've kept it at a low pricing, the price to book is at 13.2, which is much higher than what ICICI Pru or SBI Life are quoting at. So, how do you justify the valuations then?
Well, we have looked at all the valuations of insurance companies. Ultimately, we have 5 or 6 advisors, investment bankers who advised us on the issue, who took us around the world to meet potential investors. And they gave us a much higher price than what we decided. So we thought it's better. We also felt that the recommendation was on the higher side, so we sort of brought it down. And our numbers, our ROE, is much better than others. Our new business margins are 22.54%. Our ROE is 26%. Our persistency, 13-month persistency is 82%. So we have 1 trillion rupees under management in our AUM. Our solvency is 200%. You need 150%. Our claim settlement is 99% for group and 98.3% for individuals. And we settle claims fast also. So I think we have a good management team. We have a good brand. The 2 initial promoters of HDFC Life, Standard Life and HDFC, have good reputation. And we feel that it's a fair price.
Considering there have been a lot of these insurance companies that have listed so far, but to some of them recently they've gotten a subdued response. Is that a cause of concern for you? Or?
No, it is certainly a cause of concern, because insurance industry is not well understood today by investors. And they've got such a bad name in the past because of mis-selling, and so people are a little wary about insurance. Although insurance is necessary for people's protection, for safety, you get tax benefit. It's a long-term product, And particularly if you buy a protect policy, you take any loan, you take a 20-year mortgage loan of 1 crore and you take a policy of 1 crore. If something happens to the family member, the earning member, your loan is written off. So it's such a good advantage. But it's not yet picked up in India. Our penetration levels are only 3%, 3.4%, which is abysmally low, very low compared to any global standard. And it has only one way to go up. And as more people are becoming middle class, as India is a fast-growing economy, more people get jobs, more people get education, urbanization happens, life insurance is bound to do well. But it's a long-term business. If you want to invest on day one and make 20% on day two, don't invest. This is not overnight money, this is long-term money.
Then quickly, I want to add a rider to this question. What is the future of the insurance industry in India? How do you think all these companies are going to survive with the intense competition?
I think consolidation is the name of the game. There will be consolidation. There are far too many companies today. And some of them are only adding 100, 200 crores premium a year. They cannot survive. So they have to be taken over. And you will see more acquisitions as time goes on. But I think the future of insurance is very good. You see, LIC has become the largest financial company in the country. It is bigger than any bank. And the value of LIC, no one knows. It's 100% owned by government. But value will be in lakh crores. And even if government sells 10-20% of it to the public, it can wipe off the deficit, in a whole year's deficit. So it's a huge company. It's one of the most profitable companies in the government portfolio.
So then quickly want to add, do you also look to acquire any new health insurance business, or how would the growth kind of happen?
The health insurance, there is one health insurance company which we've been approached by an investment banker. So we are looking at it. Star Insurance. So everyone knows it. It's not a secret. It's there, come in the new newspapers and all over. And we've signed an NDA and we are getting some paper and we are looking at it. Health insurance is a very good business, particularly group health and individual health. And it's a growth business. Most families want to take policies in health. So we'll have a look.
Well, with that, it's a wrap on this edition of What Did You Miss? For more news and updates, stay tuned to Bloomberg.